Well, our next guest sees a range of upside inflation risks in 2025 and believes that the Fed may even ending up having to raise rates to fight off higher prices. Joining us now is Skyler Weinand, who's the CIO at Regan Capital. Skyler, really great to have you with us. And this is kind of the big area of uncertainty, right, for markets and investors and economists going into this year. How much of that comes from political risk, do you think? Is this sort of potential price upside that you see from fiscal policies in an incoming Trump administration?
Yeah, I think it's threefold. I think it's political risk. I think it's, the governor talked about term premium and the risk associated with longer duration assets. That's moved tremendously. It's moved 75, 80 basis points since September when the Fed cut interest rates. So that speaks to demand. Is the demand there for duration? Is European, Japanese demand going to be there for U.S. Treasuries? But also, I mean, I laugh when they say that they have no idea what incoming policies and how they'll affect the market in inflation, because in their last Fed notes they were actually talking about that. So they have notes that where they're worried about incoming inflation, fiscal deficits, et cetera. But then they're saying, oh, we're going to be data dependent. The Fed is worried about the incoming administration, continued money printing, $2 trillion fiscal deficits. But on the other side, you have an extremely strong consumer and corporate balance sheet. GDP expectations, Atlanta GDP expectations just rose to, I think, 2.7. So the consumer is going to continue to spend. There's a tremendous amount of dry powder. All these things bubble up to higher interest rates out 5 to 10 years, 5 to 10 year part of the curve.
And in fact, I wanted to kind of put to you our MLive blog question of the day, right, which takes a look at, do we really see the meaningful, possibility of one cut from the Fed, two? Because the question is, are traders right to price in just one? That's what traders are looking at. The Fed's latest projection is shifting to 2 rate cuts in 2025. Do you think it could actually be none, and we could have to see, how that fiscal outlook plays out? And I suppose, do you think that uncertainty comes from the fact that, well, we don't know what President Trump's administration is going to do versus what he's alluded to doing?
I mean, talk about uncertainty. It was only 3.5 months ago where we were pricing in 10 cuts. And now we're talking about 1 or 2. Since September 17th, the day before the Fed cut interest rates, 50 basis points, the bond market has lost over 4%. 5 to 10 year parts of the curve are up 100 basis points. So they want to cut. I think they want to get to 4. They want to put at least one more cut in. I think while that occurs, 5, 10, 30-year rates continue to rise above 5%. But to put this into context, this is great. We want, the economy wants and needs a steep curve. We've been living in bizarro world for the last 2.5 years with an inverted curve. And bizarro world really since the GFC, since 2009, since the Fed cut interest rates to 0 and flooded the economy with cash. So they're going to cut maybe one more time. The back end's going to go up to 5+%. We're going to have 100 basis points of steepness. And if you look at Japan right now, for example, Japan actually has 200 basis points of steepness between 2s and 30s. And so, Japan's talking about raising rates shortly. So this is good, but they might cut once, but we could see in the second half of the year them actually raising rates again because inflation might pop up, spending might get out of control, which are all good things, honestly.
Yeah, Skyler, I'm glad you raised bizarro world. I want to lean into that a little bit more because we seem to forget that part of the reason the Fed's not cutting is because this economy doesn't need stimulus. It's in pretty good shape. So if you look at markets, earnings, good old-fashioned fundamentals, is that going to be enough to drive prices higher?
What is welcome for the first time really since pre-GFC is good and bad is bad again. We lived for the last 15, 17 years where the market wanted bad news, and they wanted the Fed to keep rates at zero in order to continue to stimulate the economy. Okay, now we're just back to normal, where, GDP's up, that's great. People are going to spend money. Economy's doing well. Corporates are doing well. So it's really a generational thing. Can you move your mind back to 05, 04, when good news was good news? If you can think in that type of an economy or that type of a market, you're going to do well, okay? But if you're holding on to zero interest rate policies and quantitative easing and the Fed put, then you're likely not going to do well in this market.
Well, let's talk about some areas where you can do well, and tech, particularly tech linked to AI, has been performing very strongly. How are you looking at this area? Do you think it's overvalued? Do you add when you see dips? Or what's your plan?
No, AI is generational. It is the equivalent to the internet, power, the Industrial Revolution. So I think the move in the market has really only just started to begin, okay? I don't think it's just an NVIDIA play. NVIDIA is a hardware play. Look to software plays. There's some private companies out there that are getting extremely good valuations and multiples over very short amounts of time. 12, 24 months, these up-and-coming companies are doubling, if not quintupling, valuations. But you can also look to the big players. You can look at Meta, Google, and Microsoft really as a triumvirate on the software side. But NVIDIA, I think, is still a great play on the hardware side.
Skyler, before we let you go, I just want to quickly get your thoughts on China as well. I know you have a wait-and-see approach there. What are you waiting to see?
Well, you look at Japan, for example, you look at the United States, you look at the UK, where we're looking at 25, 30, 40-year highs in interest rates. China's going the other way, right? So for good reason. Growth is being decimated, and the wait-and-see approach is, what exactly is the government going to do to stimulate the economy? Are they going to flood the economy with cash? Are they going to go through in another building craze, building tons of apartment buildings where nobody lives in? We have no idea, okay? So it's really wait and see relative to looking at Australia, looking at the UK, US, or Japan, where rates are rising, the economy is doing well, and consumers and corporations are flush with cash.
Skyler, really great to have you with us, Skyler Weinand, who's the CIO at Regan Capital.